China just moved 660 tons of silver onto global exchanges in the span of weeks, the largest physical delivery from state vaults in over a decade. This wasn't a gradual release. It was deliberate, timed, and it caught most of the market off guard. For months, Beijing had been quietly tightening domestic silver availability, restricting exports, and watching premiums climb inside their borders. Then, without warning, they reversed, and the metal flooded out. Prices wobbled. Traders scrambled to reposition. And if you're watching this market closely, you already know moves like this don't happen by accident. They happen when someone knows something the rest of us are still trying to figure out. So the question isn't just what China did, it's why they did it now, what they're preparing for, and what it means for anyone holding exposure to this market going forward. If you're serious about understanding what's actually driving these decisions, not just the headlines, but the mechanics underneath, make sure you're subscribed, because what you're about to hear isn't being discussed in most coverage, and it matters more than the price action alone. This content is for educational and informational purposes only. It does not constitute financial, investment, or trading advice. All analysis is based on publicly available data and broader market context. Let's start with what actually happened. In late November, the Shanghai Futures Exchange saw an unusual spike in warehouse deliveries. Over 20,000 tons of silver were registered for delivery, a figure that dwarfed the typical monthly average by a factor of 5. Within days, export quotas that had been bottlenecked for months suddenly cleared. Chinese silver began moving through Hong Kong, heading toward London and New York vaults. The immediate effect was predictable. Spot premiums in Shanghai, which had been running hot at nearly 8% above London quotes, collapsed almost overnight. But the broader signal was more complex. This wasn't just supply meeting demand. It was a coordinated policy shift, executed with precision during a period when global liquidity was already under pressure and industrial demand was softening. Now, to understand why this matters, you have to back up 6 months. In the spring, China's State Reserve Bureau began restricting export permits for non-ferrous metals, including silver. The official line was domestic supply security. The real effect was a bifurcation of the market. Premiums inside China surged. Arbitrage opportunities emerged, but few could capitalize because the metal couldn't leave the country. Meanwhile, Western markets saw modest price gains, but nothing explosive. Silver hovered in a range, supported more by speculation around monetary policy than by genuine tightness. What most retail participants missed during this period was that China wasn't hoarding silver for industrial use. They were creating conditions. They were testing price elasticity, watching how the market responded to reduced flow, and positioning themselves for a larger move that wouldn't become obvious until much later. The reversal in late November wasn't a capitulation, it was a release valve, and the timing tells you everything. Global manufacturing data had started rolling over. The PMI figures out of Europe and the US were weakening. Demand forecasts for solar panels, electronics, and EV components, all major silver consumers, were being revised downward. China saw the same data everyone else did. But unlike most market participants, they weren't reacting. They were front-running. By flooding supply into a market that was about to see weaker demand anyway, they achieved 2 things. First, they prevented domestic premiums from becoming a political problem. And second, they put downward pressure on global prices at a moment when doing so would amplify the effect. This is not the behavior of a seller trying to maximize revenue. It's the behavior of a strategic actor managing a broader position. So where does that leave the rest of the market? The immediate impact was felt hardest by the funds and smaller institutions that had built long positions expecting continued tightness. When Chinese silver hit the vaults, those positions got squeezed. Hope and interest dropped. Volatility spiked briefly, then compressed. What looked like capitulation on the surface was actually just repositioning. The larger players, the ones with access to flow data and vault activity, had already adjusted. They weren't caught off guard because they'd been watching Chinese export quotas and customs filings for weeks. By the time the headline hit Bloomberg, the trade was already old news for anyone operating at that level. But here's where it gets more interesting. China didn't just dump silver and walk away. They've been systematically rebuilding their position in other metals simultaneously. Copper inventories inside China have been climbing. Aluminum stockpiles are at multi-year highs. Rare earth export restrictions remain in place. The pattern suggests they're not exiting commodities. They're rotating within them. Silver was released because it had run ahead of fundamentals, because the tactical advantage of holding it had diminished. But the broader commodity strategy hasn't changed. If anything, it's become more focused. They're moving away from speculative holds and toward materials with direct strategic value in energy transition and defense manufacturing. The other piece of this puzzle is the dollar. Silver, like most commodities, trades inversely to dollar strength. And over the past 2 months, the dollar index has been grinding higher. Not because of U.S. economic strength, but because of global uncertainty and a lack of better alternatives. When the dollar strengthens, commodities priced in dollars become less attractive to foreign buyers. China understands this dynamic better than almost anyone. By releasing silver into a strengthening dollar environment, they're effectively getting better relative value for their reserves, while simultaneously putting pressure on speculative long positions held by Western funds. It's a two-sided trade, executed through supply management rather than futures contracts. Now, what does this mean for anyone watching silver as part of a broader inflation hedge or monetary strategy? The truth is, the narrative around silver as a monetary metal has always been more aspirational than operational. Central banks hold gold. They don't hold silver. Industrial users hold silver. Speculators hold silver. But the institutions that actually move monetary policy, the ones that matter when liquidity tightens, they're not looking at silver the way they look at treasuries or gold or even Bitcoin at this point. Silver remains a hybrid asset, caught between industrial demand and speculative interest. And that dual identity makes it uniquely vulnerable to exactly the kind of move China just executed. The professionals watching this market aren't asking whether silver will go up or down. They're asking where the next source of volatility will come from and how to position around it without getting caught in a momentum trap. Right now, the signals are mixed. ETF flows have been negative for 3 consecutive months. Lease rates remain compressed, indicating no shortage of physical metal available for borrowing. But open interest on the futures side has been creeping back up, suggesting some players are starting to rebuild positions at lower levels. The question is whether that's smart money anticipating a rebound, or whether it's late cycle retail chasing a narrative that's already played out. One thing that's not being discussed enough is the role of India in all of this. India is the second largest consumer of silver globally, and their import data over the past quarter has been weaker than expected. Part of that is due to high domestic prices driven by currency depreciation. But part of it is also behavioral. Indian buyers are price sensitive, and when silver ran up earlier in the year, they pulled back. Now that prices have softened, you'd expect to see demand return. But it hasn't, at least not yet. That delay is telling. It suggests that the confidence isn't there. And if Indian buyers, who are historically among the most consistent physical accumulators, aren't stepping in, it raises the question of who else is supposed to absorb this supply. The Fed's positioning adds another layer. With rate cuts now priced out through the first half of next year, real yields are staying elevated. That environment is structurally negative for non-yielding assets like silver until there's a genuine shift in policy expectations. Not just talk, but actual cuts. The macro backdrop remains challenging. And China knows this. They didn't release silver in a vacuum. They released it into a macro environment where the headwinds were already building. That's not luck. That's timing. There's also the question of what this means for mining supply. Silver production has been relatively flat for the past 3 years. Most silver comes as a byproduct of copper, lead, and zinc mining, which means primary silver supply doesn't respond quickly to price signals. When China held back exports earlier this year, it created an artificial sense of tightness that wasn't reflected in actual mine output. Now that they've released supply, the market is adjusting to a reality that was always there but temporarily obscured. For miners, this creates a challenging environment. Prices aren't high enough to incentivize major new projects, but they're not low enough to force widespread production cuts either. That middle ground tends to persist longer than most expect, and it's exactly where we are now. Another angle worth considering is the geopolitical dimension. Silver isn't just an industrial metal or a speculative trade. It's also a component in military applications, from missile guidance systems to advanced electronics. China's decision to release silver now, at a time when global tensions are elevated, and supply chain diversification is a priority for Western governments, sends a message. It demonstrates control. It shows that Beijing can influence this market in ways that others cannot. And it reminds participants that commodity flows are as much about leverage as they are about economics. What's also notable is how little reaction there's been from other major holders. Neither the US nor any European entity has responded with a countermove. There's been no coordinated buying, no public statements, no shift in strategic reserve policy. That silence is itself informative. It suggests that Western policymakers either didn't view this as a threat, or they're choosing not to engage on this particular front. Either way, it leaves China with more room to maneuver in the future, and it reinforces the asymmetry in how different actors approach commodity strategy. For retail investors trying to make sense of this, the challenge is separating signal from noise. Social media and retail forums tend to amplify narratives that fit pre-existing beliefs. If you were bullish on silver 6 months ago, you're likely still finding reasons to be bullish now. If you were skeptical, this move probably confirms your skepticism. But the reality is more nuanced. Markets don't move in straight lines, and the participants with the most information rarely telegraph their intentions. What China did was reset the board. They took a position that was getting crowded and forced everyone to reconsider. That doesn't mean silver is going to zero, and it doesn't mean it's going to the moon. It means the next phase will be determined by factors that are still unfolding. What's next? If you're looking for a clean directional call, you're not going to get one. Not here, and not from anyone being honest about the complexity of this setup. What you can watch are the flows. Specifically, watch Shanghai premiums. If they start to widen again, that's a signal that China is tightening supply again. Watch COMEX inventories. If they start drawing down despite weaker ETF demand, that's a signal that industrial users are securing physical ahead of something they see coming. And watch the dollar. If it rolls over hard, commodities across the board will catch a bid, and silver will move with them, but it'll be a beta play, not a fundamental one. The reality is that markets like this don't resolve cleanly. They oscillate between narratives driven as much by positioning and liquidity as by supply and demand fundamentals. What China just did was reset the positioning. They took a market that was leaning long and forced it to recalibrate. Whether that sets up the next leg higher or just creates more churn depends on variables that are still unfolding. But one thing is certain. The players who understand flow, who track vault activity, who read between the lines of customs data and export quotas, they're the ones who will be positioned correctly when the next move happens. Everyone else will be reading about it after the fact. The most important moves in markets like this aren't the ones that make headlines. They're the ones that happened quietly in the background, weeks before the narrative catches up. China just made one of those moves. Whether the market has fully absorbed it yet is another question entirely. And whether you are positioned to benefit from what comes next depends entirely on how well you understand what just happened and why it matters beyond the price you see on a screen.